Asian stock markets presented a mixed picture on Friday, March 21, 2025. The overall sentiment was, well, subdued. Investors grappled with uncertainties stemming from potential U.S. trade tariffs and global interest rate trends. These factors contributed to a cautious mood across the region. While some indices managed to eke out minor gains, others succumbed to selling pressure. This mixed performance reflects the delicate balancing act faced by investors. They are weighing both opportunities and risks in the current global economic climate. The situation remains fluid, and market participants are closely monitoring developments for further clues. Japanese stocks displayed resilience, with the Nikkei 225 inching up by 0.1%. This slight increase, though modest, reflects a broader sense of optimism among investors. The market's ability to hold steady despite global economic uncertainties is a testament to the underlying strength of Japan's financial systems and investor confidence. And the broader Topix advancing by 0.7%. The Topix, which includes a wider range of stocks, showed a more significant gain, indicating that the positive sentiment was not limited to just a few sectors, but was more widespread across the market. This broader advance suggests that investors are feeling more confident about the overall economic outlook. This positive performance followed a market holiday on Thursday. The break gave investors time to digest recent economic data and news, leading to a more measured and optimistic approach when trading resumed. Market holidays often provide a breather, allowing for a reset in investor sentiment. February's Consumer Price Index data, released earlier in the day, revealed a slight uptick in inflation. This data is crucial as it provides insights into the cost of living and purchasing power of consumers. A slight increase in the CPI can indicate growing demand and economic activity, but it also raises concerns about potential overheating of the economy. This fueled expectations that the Bank of Japan might implement further interest rate hikes. The central bank's policies are closely watched as they influence borrowing costs, consumer spending, and overall economic growth. Speculation about rate hikes can lead to increased market volatility as investors adjust their strategies. Although headline inflation showed signs of cooling, underlying inflation remained stubbornly above the BOJ's 2% target. This persistent inflationary pressure is a challenge for policymakers, as it complicates efforts to balance economic growth with price stability. The central bank's target is designed to ensure a stable economic environment, but persistent inflation can undermine this goal. This persistence of inflationary pressures is likely to keep the central bank on high alert. The BOJ will need to carefully monitor economic indicators and be ready to act if inflation continues to rise. This vigilance is necessary to prevent runaway inflation, which can erode purchasing power and destabilize the economy. The BOJ, which maintained its policy rate in its recent meeting, has signaled its anticipation of sustained inflation throughout the year. This stance indicates that the central bank is prepared to take further action if necessary to control inflation. The BOJ's communication is crucial for setting market expectations and ensuring transparency in its policy decisions. Market analysts are now predicting a potential rate hike in May, following January's 25 basis point increase. This prediction is based on current economic trends and the BOJ's recent statements. A rate hike could have significant implications for borrowing costs, investment decisions, and overall economic activity. Investors will be closely watching for any signals from the BOJ in the coming months. Chinese equities, in contrast to their Japanese counterparts, experienced a pullback. This comes after a period of significant gains, largely driven by optimism surrounding government stimulus measures. Investors had been buoyed by the Chinese government's aggressive fiscal policies aimed at revitalizing the economy post-pandemic. However, the recent market movements suggest a shift in sentiment. The Shanghai Shenzhen CSI 300 index shed 0.3%, reflecting a broader trend of cautious trading. Analysts believe that the initial surge was unsustainable without concrete economic improvements. The index had previously seen a sharp rise, but the current decline indicates a more measured approach by investors, while the Shanghai Composite Index dipped by 0.2%. This slight decrease underscores the market's volatility and the delicate balance investors are trying to maintain. The Composite Index, which tracks the performance of all stocks listed on the Shanghai Stock Exchange, has been a barometer for investor confidence in China's economic recovery. Hong Kong's Hang Seng Index, heavily influenced by Chinese tech giants, declined by 0.6%. The tech sector, which had been a major driver of the index's previous gains, saw a notable pullback. This decline is partly due to regulatory uncertainties and profit-taking by investors who had capitalized on the earlier rally. This retreat can be attributed in part to profit-taking after a period of robust gains fueled by stimulus optimism. Investors are now reassessing their positions, considering the potential risks and rewards in the current economic climate. The initial euphoria has given way to a more cautious outlook as market participants await further policy announcements. Chinese tech stocks in particular had surged to multi-year highs, driven by excitement surrounding China's advancements in artificial intelligence. The tech sector's growth has been a focal point for investors, with many betting on the long-term potential of AI and other emerging technologies. However, the recent pullback suggests that some investors are locking in gains amid concerns about overvaluation. However, the recent rally lost steam as some investors opted to lock in profits. This has led to a more subdued market environment, with trading volumes decreasing and volatility increasing. The shift in investor sentiment highlights the challenges facing the Chinese market as it navigates the complexities of economic recovery and regulatory changes. Market focus now shifts to Beijing's plans for additional stimulus measures aimed at bolstering consumer spending, a crucial driver of economic growth. The government's next steps will be closely watched by investors, as they could provide the necessary boost to sustain the economic recovery. As Beijing deliberates on its policy options, the market remains in a state of anticipation, waiting for clear signals on the future direction of the economy. Elsewhere in the Asia-Pacific region, market performance was mixed. Australia's benchmark S&P/ASX 200 index edged up by 0.4%, supported by gains in the materials and energy sectors. Singapore's Straits Times Index slipped by a marginal 0.1%, reflecting the broader regional caution. South Korea's KOSPI Index managed to add 0.2%, but sentiment remained fragile as investors awaited a delayed ruling on the impeachment of President Yoon Suk-yeol. Futures contracts for India's Nifty 50 index pointed towards a flat opening, suggesting a potential pause in the index's recent 5-week rally. Section 5. The looming shadow of U.S. trade policy. The specter of U.S. trade policy continued to cast a long shadow over Asian markets. The uncertainty surrounding the policies has created a volatile environment, causing fluctuations in stock prices and investor sentiment. Asian markets, which are heavily reliant on exports, are particularly vulnerable to any changes in U.S. trade policy. The fear of potential tariffs and trade barriers has led to a cautious approach among investors who are wary of making significant moves in such an unpredictable climate. The region's export-oriented economies remain sensitive to any disruptions in global trade flows. The intricate supply chains that span across continents mean that even minor policy shifts can have far-reaching consequences. Ports and shipping companies are on high alert, as any delays or additional costs could ripple through the entire economy. The uncertainty has also led to a slowdown in new trade deals, as businesses wait to see how the situation will unfold. President Trump's April 2nd deadline for the imposition of reciprocal tariffs on a range of goods, if enacted, could have significant repercussions for Asian exporters. These tariffs could lead to increased costs for consumers and businesses alike, potentially reducing demand for Asian products. The threat of a trade war looms large, with both sides preparing for a prolonged battle that could disrupt global trade for years to come. The stakes are high, and the outcome remains uncertain. While U.S. stock index futures edged slightly higher in Asian trading hours, suggesting some bargain hunting after recent declines, uncertainties surrounding trade relations persist. Investors are treading carefully, balancing the potential for short-term gains against the risk of long-term instability. The market's reaction to any new developments in trade negotiations will be closely watched, as it could provide clues about the future direction of the global economy. Investors are closely monitoring negotiations and pronouncements from both sides of the Pacific for any signs of progress or escalation. The stakes are high and the potential impact on global trade and economic growth is significant. As the situation evolves, businesses and investors alike are preparing for a range of possible outcomes, from a resolution that stabilizes markets to a prolonged period of uncertainty and disruption. The world watches with bated breath, hoping for a positive resolution to the looming shadow of U.S. trade policy. Section 6. Navigating the uncertain waters of monetary policy. The global interest rate environment adds another layer of complexity for Asian markets. The U.S. Federal Reserve's recent mixed signals regarding the future path of interest rate hikes have contributed to market volatility. A more hawkish stance from the Fed, leading to higher U.S. interest rates, could potentially trigger capital outflows from emerging Asian economies. This delicate backdrop underscores the challenges faced by policymakers in the region. They must strike a balance between supporting economic growth and managing inflationary pressures, all while navigating the uncertainties emanating from the global economy. Section 7. Stimulus hopes and economic rebalancing in China. China's economic trajectory holds significant sway over the outlook for the broader Asian region. While the country's recent stimulus measures have provided some support, concerns linger about the sustainability of debt-fueled growth. Market participants are eagerly awaiting further details on Beijing's plans for additional stimulus, particularly measures aimed at stimulating domestic consumption. A shift towards consumption-driven growth as opposed to reliance on investment and exports is seen as crucial for China's long-term economic health. Section 8. Investor strategies in a volatile landscape. The current market environment demands a nuanced and adaptable approach from investors. Diversification across asset classes and geographies remains paramount, mitigating the impact of volatility in any single market. A long-term investment horizon coupled with a focus on quality companies with strong fundamentals can help investors navigate short-term market fluctuations. Staying informed about global economic developments and policy decisions is crucial for making informed investment choices. Section 9. Maintaining perspective in turbulent times. While market volatility can be unsettling, it is important to maintain perspective. Market corrections are a natural part of the economic cycle, offering both opportunities and challenges. History has demonstrated that over the long term, markets tend to reward patience and disciplined investing. By staying focused on your financial goals, diversifying your investments, and seeking professional advice when needed, you can weather market storms and emerge stronger on the other side. Thanks for watching, like and subscribe.